Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company CrowdStrike, and this is a company that I've heard a lot about. I think it was one of those hyped companies, and seeing that their earnings are actually coming out on the 9th at around 4:05 p.m. I want to see if this company's fundamentals actually match the ticker price. So with that said, let's get started with this analysis. Alright guys, we're going to go straight into the spreadsheet. Ticker symbol of CRWD, market cap of around $36 billion, PE guys of NA, meaning that they do not make any money when it comes to their earnings. This is really bad because we have seen this in a couple other companies before. We've seen this in Palantir and Peloton, and well, if you guys have seen those videos, then you pretty much know what we're going to see when it comes to their fundamentals, and even when it comes to the target share prices. Hint hint, there are none. The calculator does not work when it comes to analyzing companies that have negative cash flow. So unfortunately, can't really come up with the target share price when they have negative cash flow. But seeing that the PE and that their fundamentals are probably going to be really bad, the current share price, guys, is $156.77. Now, this to me is an absolute absurdity because, well, remember what you're paying for when you buy a company. You are paying for the company's fundamentals, and figuring out a good price to buy these fundamentals at pretty much make the entire deal, right? So the fact that, just looking at the PE, the fact that their PE is NA, meaning that they make no money when it comes to their earnings, to me, $156.77 is not justifiable. Now, we went straight into the spreadsheet because their annual dividends is 0. They do not pay a dividend, which means all of their 5-year average free cash flow goes straight into themselves, which they desperately need. Now, their 5-year average free cash flow is around $25 billion. And, well, that's actually not a lot, guys. That's really not a lot, okay? The fact that, yes, it's in the millions of dollars is pretty bad, but $24 million for a company, I mean, I get that they're just starting up, and they do have a lot of growth potential in the future, but again, when it comes to buying a company, understand that you are paying for their fundamentals, and one of them is the free cash flow. So you want the cash flow to be somewhat decent if you're willing to buy it at a certain price. But now let's actually see how these fundamentals actually look like, starting off with the net income 5 years ago of negative $91.3 million to 1 year ago of negative $92.6 million, which, guys, is a decrease of 1%. Now, even though this decrease is only 1%, the fact that, guys, 4 years ago, 3 years ago, and 2 years ago, they were all the way down to $140 million in the red. So negative $140 million. That's really bad. And, okay, a decrease of 1%. Here's the thing, though. The decrease of 1% was still in the red, right? They still had negative income, even though they had a decrease of 1%. Really bad to see. They have not had a single year where they were positive in the net income. Does this mean that they will not be positive in the future when it comes to their net income? Not necessarily, right? But just looking at the past, to me, you definitely need some kind of indicator that they will have a positive income into the future. And right now, you clearly don't have that. Now let's move on to the free cash flow. Cash from operations less your capital expenditures. This is the lifeblood of the company. Now guys, me personally, I like to put a lot more weight when looking at the free cash flow than the other two metrics when it comes to their income, right? When it comes to their net income and revenue, you can pretty much fudge those numbers, right? There you have SEC rules and you have IRS rules. There are ways to fudge those numbers. Cash flow is significantly harder because it is just the cash from operations less your capital expenditures. Does that mean that you can't fudge them? No, but it is just significantly harder. 5 years ago of negative $58.6 million to 1 year ago of positive $304 million. This, guys, on the 5 years is an increase of 618%, and as we saw, they do have a 5-year average free cash flow around $25 million. Now, the fact of the matter is that this company has negative cash flow. A lot of people will start screaming at me around this point saying that no, they do not have negative free cash flow. See, last year they did $304 million, and this year they're probably going to make even more than that. Okay, great. The fact of the matter is that they did negative $58 million, negative $81.7 million, negative 58.9 million, and 2 years ago is when they barely just went positive at 19.7 million. Guys, all in all, they have negative cash flow. Just because you had 1 or 2 years of positive cash flow, actually not even 1 or 2 years, because I wouldn't even consider 2 years ago a positive cash flow. Yes, it's positive when it comes to these metrics. However, what's $19 million? That's absolutely nothing. They were barely positive, right? For all these metrics, I'm only considering this $303 million. And for all we know, this could have been a fluke. For all we know, they could have just gotten lucky. I mean, who knows what could have happened as to why they did $304 million last year. I really don't know. I honestly have no idea. For all intents and purposes, I look at this free cash flow, they're all negative to me. This company has negative free cash flow. If in the future they continue to go positive and consistently increase going positive, then I'll take it back and say that yes, now they have positive free cash flow, but right now they have negative free cash flow. Next, let's look at the revenue 5 years ago of 52.7 million to 1 year ago of 874.4 million, which is a huge increase, guys, of 1,559.2%. Oh my god, this is huge increase. And not just that, guys, this is the first metric that we see where not only do they have everything positive, but they have everything positive and consistently increasing, which is what you want to see. Now, even though the revenue is doing great, the fact of the matter is that this one metric doesn't necessarily cut it when it comes to me wanting to invest this, at least right now. Now let's take a look at the total assets and total liabilities. What this metric does is it simulates if the company were to liquidate all of their assets, would they be able to cover their liabilities, number one, and how much money would they have after paying off all their liabilities, number two. Currently, as you can see right here, CrowdStrike, well, they have around $1.1 billion after paying off their debts, which is really good. And not only that, last year they were even higher at 1.4, and 2 years ago they were around $678.5 million. Obviously, I gotta mention it, and you guys are looking at it. 3 years ago, guys, they were barely up at 50 million. 4 years ago, they were down negative 12.3 million, and 5 years ago, they were down negative $19.1 million. Sure, can they cover their assets now? Yes. I would need to see a couple more years where their assets actually cover their liabilities for me to actually trust their current numbers, because again, this could all switch within a couple years. And the last thing you want to do is get caught in a trap where you're seeing this over here, the current year and the 1 year ago, and even the 2 year ago, and say, oh, they'll continue this into the future, and then next year, boom, they just completely go negative. You don't want to get trapped in that cycle. So at least for me, I would need to see where this company is going to go to when it comes to their debts and assets into the future. Now, the average total assets is around 1.1 billion. The average total liabilities is around 522 million, and doing the average assets minus the average liabilities, we get around $540.7 million. Now let's take a look at the silent killer when it comes to investing. This metric, a lot of people tend to overlook, and it really is terrible that people overlook this, because guys, this is the metric that tells you whether or not the company is diluting you. I had a friend a couple days ago asking me if one of my metrics actually shows whether the company's board and CEO is actually taking care of the company and buying back their shares or selling. He didn't understand that shares outstanding meant this. I had to explain to him. I have that already. That's why I show the shares outstanding and how much they have increased or decreased within the past 5 years. And I also take a look at the percentage increase or decrease on that 5 years and from the previous to the current year. He didn't understand this. Again, a lot of people don't understand this. A lot of people don't even know this metric exists. And it's really important for you guys to know, because this tells you whether or not you are being diluted as the investor. Currently, CrowdStrike, 5 years ago of 40.5 million shares to today, guys, of a whopping 229.3 million shares. On the 5 years, guys, this is a massive increase of 466.17%. And from the previous year to the current year, so from 1 year ago to today, they increased it a whopping 2.5%, which is huge. Not only that, they have increased their shares outstanding from 2 years ago to 1 year ago to today slightly, yet from 3 years ago to 2 years ago, they just made one of the biggest increases in shares outstanding. This right here diluted you as the investor, and probably because the stock was hyped, the company said people are going to buy our stock no matter what. Let's just issue shares instead of taking on debt, which is probably why, ironically enough, actually, let's make a comparison right here live, guys. Take a look at this. 2 years ago, boom, $678.5 million after assets minus liabilities. Exactly that same year, they issued a whole ton of shares. Kind of coincidence? I would say not, because would a company take on debt knowing that their stock price is overvalued? No, they would just issue the shares because it pays off their debts, and they know people are going to buy it because they know the company's hyped. The fact that you actually see this comparison right here, right now, look at this. I mean, you even see it. Even look at this, guys. 1 year ago, you even had a higher increase when it comes to their assets and liabilities, and their shares went up. Now, currently, their assets and liabilities are slightly lower. However, their shares outstanding actually went up even more. What leads me to believe is that this number will actually go up as the year progresses, because they have issued more shares. But I digress. This company is diluting you as the investor, and well, it's really bad, and this right here is a huge red flag for me. And lastly, guys, we got the cash equivalents. And as of today, they have around $1.9 billion in cash equivalents, with an average cash equivalents around $710 to $711 million. Now, this is a part of the video that I would normally go through my assumptions, give you the growth factor, the projected share buyback, etc, and come up with a target share price for debt, and margins to safety. However, there is no point in me doing that, because unfortunately, as I've stated several times before, and a lot of people don't believe me when I say this, but it's true, discounted free cash flow does not work when the company has negative cash flow. Yes, this company has negative cash flow. Their average cash flow within the past 5 years has been more red than positive, meaning that they do have negative cash flow. All in all, when it comes to this, guys, y'all just saw those fundamentals. It is really bad. The only fundamentals that are kind of good is the total assets minus total liabilities and their revenue. Aside from that, they pretty much have everything in the red. Yeah, it's showing that their cash flow is starting to go in the positive. However, I would need a lot more years, maybe like 2 or 3 more years into the future with that consistent growth in their free cash flow. And hopefully we get consistent growth in their income for me to even take a look at this. The way that this stands right now, at $156.77, this to me is just, it's really bad, and I'm gonna stay away with this. But again, this is just my opinion. Don't just follow me, right? If you really like this company and you want to try and use this calculator, then by all means you can have it and you can make your own assumptions. I don't see why you would. Their metrics are really bad, but I'm not telling you what to do. You do you. This is not financial advice. I'm just showing you guys the raw numbers and giving you guys my opinion. But that pretty much does it for this video. Like if you like, comment, subscribe. It really does support with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble. In addition to my stock analysis videos and crypto videos, you will find exclusives as well. In regards to Odyssey, Rumble, and YouTube, I also have a Let's Play channel called Fatal Place. Link in the description below, where I'm almost finished with Pokemon Legends Arceus, and I'm also putting up some Bloons TD Battles content as well. So if you're interested in that, you can follow me there. With that said, peace out, and be on the lookout for the next stock analysis video.